You may have never missed a payment in your life. You pay every bill on time, earn a steady income, and everyone around you thinks you are good with money. But you could still be quietly getting poorer every single month. Not because you spend too much, not because you have failed to invest, but because there is one number on your debt statements that you may have never checked. That number can tell you whether your mortgage is helping you build wealth or slowly draining money from your pocket. It can also reveal whether investing right now is a smart decision, or whether you are earning 8% in one place while silently losing 20% somewhere else. By the end of this video, you will know how to look at any debt and determine whether it is making you richer or poorer. And the best investment available to you may not be in the stock market. It may already be hiding inside the bill you receive every month. Most of us are taught that debt comes in two categories. Good debt is the money you borrow to buy a home, pay for an education, start a business, or invest in an asset. Bad debt is credit card debt, personal loans, car financing, or installment plans used to buy things that lose value over time. That classification sounds perfectly reasonable, but it has one major flaw. It judges a debt by what you purchased instead of measuring how much that debt is actually taking from your pocket. Look at the basic mechanism. A mortgage and a credit card balance work in exactly the same way. You receive money or purchasing power today. Then you agree to repay it in the future, plus an additional fee for using someone else's money. That fee is called interest. Mechanically, the two debts are not opposites. They are the same financial instrument. The real difference is the price you are paying to carry them. A low-interest mortgage may allow you to keep more of your cash available for investing, building a business, or creating another source of income. But a mortgage with an excessive interest rate, stretched across decades and far beyond what your income can comfortably support, can still destroy your wealth. And the reverse is also true. Using a credit card is not automatically bad if you pay the entire balance on time and never owe interest. The problem is not the name attached to the debt. The problem is the price you must pay to use someone else's money. So stop asking only, is this good debt or bad debt? Start asking the question that actually matters. How much is this debt costing me every single year? Now we come to the most important number in this entire discussion. It is the difference between two rates. The first is the real interest rate you are paying on your debt. The second is the return you could reasonably earn by using that same money somewhere else. Imagine you are carrying a debt that costs you 20% per year. At the same time, you have some extra cash and are considering an investment that you expect to return around 8%. At first, the decision may seem obvious. You might think, I will invest the money, let it grow, and continue paying the debt gradually. But look at the actual math. You are earning 8% on one side while paying 20% on the other. Your real position is not positive 8%. It is negative 12%. And that is before accounting for taxes, investment fees, or the possibility that your investment loses value. Now reverse the situation. Suppose you have a fixed-rate loan costing you 4% per year. You can use your remaining cash in an activity that may reasonably produce an 8% return after considering taxes and risk. In that case, you are borrowing money at a lower cost than the return your capital may generate. That 4% difference can potentially help your wealth grow. The basic formula is simple. Take your expected return after taxes and risk, then subtract the true cost of your debt. If the result is negative, the debt is pulling you backward. If the result is positive and the difference is large enough to provide a reasonable margin of safety, the debt may be helping you use your capital more efficiently. But pay close attention to one word: expected. The interest on your debt is something you are contractually required to pay. Your investment return is usually not guaranteed. You cannot honestly compare a guaranteed 10% borrowing cost with a promise that a stock might rise by 12%. One number is certain. The other is only a possibility. That is why expected investment returns must always be adjusted for taxes, volatility, fees, and the risk of losing money. And it is also why high-interest debt becomes so difficult to overcome. The higher the cost of the debt, the more extraordinary and more uncertain your investment return must be just to break even. Here is the part most people have never considered. When you pay off a debt charging 20% interest, you are not simply eliminating a monthly bill. You are effectively creating a return equal to 20%. And that return has three extremely powerful advantages. First, it is almost guaranteed. Every dollar you use to reduce the balance immediately stops generating interest against you. There is no waiting period. There is no prediction involved. The cost simply disappears. Second, that return does not depend on the market. You do not need stock prices to rise. You do not need real estate values to increase. And you do not need to predict what the economy will do next. Third, the money you save by avoiding interest is generally not taxed like investment income. You are not earning taxable profit. You are removing a guaranteed expense. Imagine you owe 100 million Vietnamese dong on a credit card, charging an effective interest rate of 25% per year. If you leave that balance unchanged, it could cost you approximately 25 million dong in interest over 1 year before including any additional fees. Now, imagine using that same 100 million dong to invest and earning a 10% return. You would make approximately 10 million dong before taxes, fees, and investment risk. That may sound like a profit, but at the same time, the credit card debt is costing you about 25 million dong. You are not truly gaining 10 million. Your overall position is approximately negative 15 million dong. That is the calculation many people miss. They focus on what the investment earned while ignoring what the debt removed from the other side. So before asking which stock to buy, which fund to choose, or which business opportunity to pursue, check the interest rates on the debts you already carry. Because the highest returning and lowest risk investment available to you may not be found in the stock market. It may be paying off the high interest debt that is already taking money from you every month. Imagine two people who earn exactly the same income. The first is Jake. Jake has never missed a payment. He follows a clear budget, pays every bill on time, and genuinely believes he is financially responsible. And by most traditional standards, he is. But Jake is carrying an $8,000 credit card balance at an interest rate of approximately 21.5%. Every month, he pays about $200 toward the balance. From Jake's perspective, he is making progress. He sees the payment leave his account each month and assumes the debt is slowly disappearing. But the numbers tell a different story. During the early stages of repayment, most of Jake's monthly payment is not reducing the balance. It is paying interest. On an $8,000 balance, an annual interest rate of 21.5% costs him approximately $1,720 every year. That is more than $140 every month just to continue carrying money he already spent. Jake is not buying anything new with that payment. He is simply renting yesterday's purchases from the bank. And yet, everything appears normal. He still pays on time. His credit score may remain healthy. The bank does not call him. No warning alarm appears. But month after month, part of Jake's wealth quietly moves from his account to the lender. Now look at Brian. Brian also has debt. He has a mortgage with a fixed interest rate that is significantly lower than the rate on Jake's credit card. Brian does not try to eliminate every debt as quickly as possible, but he follows one important rule. He refuses to carry consumer debt that costs more than his mortgage. After meeting his required payments and maintaining an emergency fund, Brian directs his remaining cash toward assets with the potential to grow over the long term. Jake and Brian both owe money. They both make their payments on time, and both may appear financially disciplined from the outside. But the real difference is not simply discipline. The difference is which direction the interest rate is working. Jake's money is working for the bank at more than 20% per year. Brian's money has an opportunity to work for him while his lower-cost mortgage is paid according to schedule. That distinction can create an enormous gap in wealth over time. The lesson is simple but important. Paying on time only proves that you are meeting the terms of your contract. It protects you from late fees, penalties, and damage to your credit. But it does not prove that the debt itself is a good financial decision. Being current on your payments is not the same as being financially efficient. You can follow every rule, never miss a deadline, and still allow expensive debt to quietly make you poorer. You may have heard the statement, "The wealthy use debt to become even wealthier." That statement is partly true, but it is also one of the easiest financial ideas to misunderstand. It does not mean that borrowing more money automatically makes you richer, and it certainly does not mean that you should take out consumer loans or borrow money to invest in an asset you do not fully understand. Wealthy people tend to use debt only when three conditions appear at the same time. First, the cost of borrowing is relatively low. Second, the loan is supported by an asset with real value. And third, the asset or activity being financed has a reasonable chance of producing a return greater than the cost of the debt. Imagine someone who owns a portfolio of stocks, valuable real estate, or a growing business. When that person needs cash, selling the asset may not always be the best option. Selling could trigger taxes. It could interrupt the future growth of the asset, and it could force the owner to give up something that may become far more valuable over time. Instead, the owner may borrow against the value of the asset at an acceptable interest rate. The asset remains in place and still has the opportunity to grow. Meanwhile, the loan provides the cash that is needed today. That is how debt can become a financial tool rather than simply a financial burden. But this strategy comes with very real risks. If the value of the asset falls sharply, the borrower may be required to provide additional collateral. If interest rates rise, the profitable gap between the return and the borrowing cost may disappear. And if the borrower does not have enough cash flow to make the payments, the asset may have to be sold at the worst possible moment. So, the lesson is not to imitate wealthy people by borrowing money to invest. The lesson is to understand how they evaluate the decision. They do not simply ask, "Is debt bad?" They ask, "What is the true cost of this capital? What source of cash flow will repay the loan? Is the expected return after taxes and risk genuinely higher than the interest cost? And what happens if the asset falls in value?" Those questions turn debt from a guess into a calculated decision. The wealthy do not possess a secret financial instrument that everyone else is denied. They are using the same basic tool available to everyone. The difference is that they try to remain on the favorable side of the calculation. And just as importantly, they prepare for the possibility that the calculation may not work out as expected. Now let us turn everything you have heard into a practical action plan. First, list every debt you currently have. Include credit cards, personal loans, installment plans, car loans, student loans, mortgages, and money borrowed from friends or family. Do not write down only the monthly payment. Record the remaining balance and the true annual interest rate. Second, calculate the full cost of each loan. A loan advertised with a low rate may also include application fees, insurance charges, management fees, or a much higher rate after the promotional period ends. What matters is the real annual cost, not the largest number shown in the advertisement. Third, arrange your debts from the highest interest rate to the lowest. Credit cards, fast personal loans, and expensive installment plans will often appear at the top. Lower-cost fixed mortgages will usually appear closer to the bottom. Fourth, establish a comparison line. As a general reference, debt above approximately 8% should usually receive priority. Debt below approximately 6%, especially when the rate is fixed, may be paid according to schedule while some money is invested elsewhere. Between 6% and 8% is a genuine gray zone, but these figures are not universal rules. Your decision must also reflect realistic investment returns, taxes, risk tolerance, and the stability of your income. Fifth, protect your emergency fund. Do not use every dollar of cash to repay debt and then return to a credit card when your car breaks down, you lose your job, or your family faces an emergency. A reasonable cash reserve helps prevent you from falling back into high-interest debt. Finally, direct your extra money toward the debt with the highest guaranteed payoff. Imagine you have 3 debts: a credit card charging 24%, a personal loan charging 13%, and a mortgage charging 6%. Make the required minimum payment on all three. Then direct the remaining money toward the 24% credit card. Once that balance is gone, move the entire payment toward the 13% personal loan. Only after the expensive debts have disappeared should you compare making extra mortgage payments with investing. The goal is not to avoid debt forever. The goal is to prevent expensive debt from remaining long enough to take control of your financial future. Debt does not automatically make you poor, and being debt-free does not automatically make you wealthy. Debt is simply a lever. When the cost of borrowing is higher than the value your money can create, that lever pulls you backward. But when the borrowing cost is low, your cash flow is stable, and the return after taxes and risk is meaningfully higher, the same lever may help move you forward. When this video ends, open your loan agreements and account statements. Write the interest rate beside every debt you owe. Then ask yourself one question. Is this interest rate working for me, or am I working to pay for it? If this video changed the way you think about debt, share it with someone who is trying to make better financial decisions. And subscribe, because in the next video, we will calculate exactly which debts should be paid off first and which ones may be worth keeping.